Well, do you know what your superannuation fund is actually investing in? Well, super funds lost nearly 2% in the September quarter, so it's a very good time to find out. SBS Finance editor Ricardo Goncalves joins us once again in the studio. Ricardo, tell us the details.
Janice, one of the reasons why we've seen this lacklustre performance is because many fund managers track stock market indices to judge their successes. Now, to do this, they invest in blue chip stocks. They're usually our biggest companies with a reputation for quality, reliability and profitability in good times and bad. But given the market's recent volatility, are they now cheap?
The face of Australia's share market has changed to reflect the shifting broader economy. Back in 1980, resource stocks dominated the landscape. These days, financial stocks are taking a greater slice of the pie.
From an investor's perspective, there are far more options for them to diversify their holdings.
The global economic slowdown has hit traditional blue chip stocks like our major miners, banks, property and telco companies. So are they now cheap?
When you look at it relative to its long-term trend, the ASX 20 is actually trading at levels below its historic PE.
PE is price to earnings ratio, a measure used by analysts to gauge value. The higher the PE, the more expensive. Historically, that ratio sits at 16.5% for the index which tracks our biggest 20 companies. It's fluctuated over the past 15 years. Right now, it sits at 15 times.
If you were to look at it as a broader collective, yes, they're cheap now.
Blue chip stocks form the basis of many superannuation funds. So if the market rises or falls, your fund generally follows in that same direction. The problem is when you take a closer look at which stocks and how they're invested, these funds are actually quite similar, meaning less choice for consumers.
Global fund manager Alex Pollock has done a comparison of 10 major funds which hold blue chip stocks.
What was interesting about it is that they all hold them in pretty much the same weightings.
He says many fund managers are playing safe to hold business.
They just choose the stocks that are in the index and the index goes down. They simply say the index went down and we went down with it, no penalty.
Except for the investor who misses out from a lack of diversification.
There are alternatives. If you hold a portfolio of stocks that are denominated in US dollars, you've got a 25% currency benefit in the last 12 months just from the currency itself.
But if offshore investments aren't your thing,
if you have the ability to dig a little deeper into the market and identify quality up-and-comers, well, the future ASX 20 businesses of tomorrow may very well be the biggest turbochargers to your overall portfolio.
if you need help, see your financial advisor.